52 trillion. That's the size of the financial time bomb sitting right under every American investor's portfolio. At least that's what Hugh just told me, one of our research kittens. And the threats are significant. We have passive investing, we have a demographic cliff, and we have the AI job risk. So by the end of this video, you will not be terrified or scared. Instead, you'll understand exactly what Wall Street insiders are quietly preparing for and how you can protect yourself. Plus, I'll reveal the one simple test that tells you if your portfolio will survive if this actually materializes. Most investors fail this test completely. If you're wondering who the heck I am, I'm Felix Prehn. I'm a former investment banker. I'm the founder of the Goat Academy with over 20,000 students. And I've seen market crashes from the inside. And what I'm about to share isn't fear-mongering. It's good risk management. It's what gets people to their retirement. So this isn't about timing the market perfectly either. It's about understanding the game that's changed forever. And if you stick around to the end, I'll also show you the exact 3-step system Wall Street pros are using right now to turn this crisis into an opportunity. In fact, if you haven't got the patience, just run away right now and go to felixfriends.org/get-free, where you get that 15-minute 3-rules-based system. And that's going to give you actually probably more value than this video. And I'm just being honest with you there, because understanding the market right now is always important, but if you don't know what to do about it, then it isn't actually all that useful. So always start with the skills, then start with what's happening right now. So what I'm about to show you will completely change how you think about index funds as lovely ETFs. The unintended consequence of index fund investing, which is what everybody seems to be doing right now, is this. An active investor is somebody who, goes to a restaurant, they taste stuff, they compare prices, they decide what's worth buying, right? So it's a process. The passive investor just goes in and goes, whatever you've got, I'll eat it, right? Now, there's nothing wrong with that. And it's much, much better to buy index funds than to not be invested. So don't take me as an index fund hater. But this passive investing issue is a problem. Why is it a problem? Because nobody is selecting stocks anymore. The scale of automatic buying is at an extraordinary level. The reason the S&P 500 has gone up so much is because most of that money comes from index funds. So it's a little bit like the lottery ticket effect. Think about this. Say lottery tickets right now are $10. Now say we require everybody out of their 401ks and all their retirement portfolios to buy a lottery ticket every week. What do you think would happen to the price of lottery tickets? Well, it would go up to probably $50, and then it would probably go up to $100, and then it would just keep going up, right? Because more and more money would pour into this lottery ticket fund, and therefore the prices would just keep going up and up and up because the demand never stops. That's what's happening to stocks right now. Now, what if, for some reason, this endless demand wasn't actually endless and it would start selling? It would then indiscriminately sell everything. And what do you think would happen to the US stock market? The S&P, by the way, is 2 times the size of the entire US economy. So this is a pretty big one. So in the next 4 minutes, I'm going to reveal why your retirement timeline might literally be off, completely wrong. Baby boomer retirement wave is this. 10,000 Americans turn 65 every single day. And those guys are now taking from their retirement funds, and they're no longer contributing, which means they're not buying the S&P 500 through this ETF scheme. They're now selling it. So your net inflows, literally 40 years of money pouring in, is now becoming net outflows. And if you imagine the stock market as a bathtub with a pretty naked lady in it, then what happens? Well, at the moment, the faucet's on. That's the retirement funds coming in. The drain's closed, very few withdrawals. The water level keeps rising, right? The bubbles keep going higher and higher, and it just looks beautiful. And then what's about to happen is this. The faucet's turned off because the retirees want to enjoy the fruits of their labor. And therefore, they're starting to sell. So they're opening the drain. So the water level, well, it goes down. Now, if you are just focused on the naked lady in there still, you might think that's a wonderful thing, but let's focus on the water level, guys, okay? Focus, stay with me on this. And the tipping point comes when at the same time, unemployment goes a little higher. Let me connect the dots for that for you as well. Because unemployment, you might have noticed, has just gone up, right? The Trump administration has said there are 900,000 jobs just disappeared. Well, the previous administration made them up, and it's not a Democrat versus Republican thing. Whoever is in power usually makes up jobs. This lot is unusual. They want to have there to be less jobs so that interest rates go down, but that's a whole completely different story, different video. So what's happening is, well, when we look at 2008, unemployment went up. You look at 2020, unemployment went up. What happened? Well, you might still be thinking the demographic shift is happening slowly, right? The retirement thing, it isn't an overnight thing. We've got time. But the unemployment, if it picks up, what happens? You get fewer 401k contributions. More people retire early. Companies cut matching contributions. And the net flows go from positive to negative again. So now you got an even bigger hole in that bathtub of yours. And we saw that in the 2008, we saw it during COVID. And that's a problem, potentially. But you might still think, well, this is not going to happen overnight. I've got time, right? Well, let me tell you, unfortunately, there is a third part to this. And this could speed up everything by 10 times. So in the next couple of minutes, I show you why AI might eliminate many jobs, possibly even your job, especially if you're a white-collar worker, by the way. It's the accountants and the lawyers and those guys. They're actually most at risk. People are thinking about warehouse workers. Yeah, that'll happen too, but it's actually, the likes of you and me that are most at risk, right? Now, I no longer have a job, thankfully, but I used to be a lawyer, I used to be a banker, and a lot of those tasks you can automate them, right? So there are people like Dario Amodei from Anthropic who are saying we're going to lose 50% of white-collar jobs in the next 5 years. So not by 2096 or something, no, 5 years. And maybe that's a little pessimistic. I hope it is pessimistic because it would do a lot of bad stuff to a lot of people. But the kind of analysts, the accountants, the customer service, the middle managers, lawyers, yeah, now everyone's cheering, right? A lot of those jobs are not required because AI can do it just as quick and better. So unemployment could actually go up. We might see significantly higher unemployment. If I could spell unemployment, right? Never trust a guy who can spell the word unemployment. So you kind of get this doom loop, and I tried to make this chart straight. I failed miserably. I'm not very good at making these things. But anyway, but what happens? Well, you get higher unemployment. You get fewer 401k contributions buying the S&P. You get more fund redemptions because more people are, getting laid off. So you get selling pressure. The S&P drops. And then what happens when the S&P drops? Well, guess what? The ETFs have to sell. The ETFs have to match the market. They can't hold on. There's not an actively managed fund. There is no optionality here. So those guys sell. And then what happens? Well, more people panic, more people sell, which likely leads to higher unemployment. And you're like, woo, going to this doom loop. So not a pretty time. So passive investing could slow down. The demographic are reversing and AI is accelerating. And that's what makes this dangerous. And at the same time, the stock market is trading at nearly the highest valuation we've ever seen. I know all this sounds doomy and gloomy, but it isn't because I'm a cheerful chap and there's some good news in here. Because every crisis actually creates massive opportunity for those who know what to look for. So I'm going to show you in the next section what the smart money is doing right now, because that's going to be useful. But we need to take this in, and just because we don't want to hear it doesn't mean it isn't the potential. So what are smart investors doing? Well, you kind of want to stress test your portfolio. So it's really all about risk management. That's really what it's all about. It's diversification beyond the S&P. Buying the S&P is not really true diversification. You're basically putting all your money into, Apple, Nvidia, Microsoft, a couple of others. It's the top 10 stocks that are basically the entire thing anyway. You're not getting exposure to, say, commodities or real estate or assets that are not as dependent on these US passive flows. So what would I focus on? Well, focus on strong cash generation. companies that actually make money, have low debt levels, and have powerful brands so they can keep charging whatever they want to be charging. That's what I want to focus on. And if you want the complete playbook, literally the exact system that I use to identify opportunities in any market condition, and I bought some stocks this morning and I'll probably buy some stocks tomorrow, is very, very simple. It's a 15-minute, 3-step playbook. I learned it from my mentors. I didn't come up with it because I'm so smart. I learned it from my mentors, and I put it together in a way that I think is very, very easy and simple to implement and learn. And that's what we teach. And you can get that at felixfriends.org/get-free. And it's free. Now, the get free doesn't mean get it for free. It means you get free, as in you get out of your cubicle prison or whatever you're presently in, whatever is bothering you. So what I'd say to you is just don't be this guy. Oh, I saw this coming. I watched this video, but I didn't act on it. So I'm not telling you to sell everything. I'm not telling you to panic or run around. I'm just telling you to take your portfolio a bit more seriously, because we're at a tipping point. We're at a place where everything is changing. And maybe the government will just keep bailing us out, maybe, but I don't like to rely on other people. I like to blame myself for everything that goes wrong in life, and that way I can fix it. That's a beautiful lesson, I think, right there. So if you got some value out of this, go to felixfriends.org/get-free right now, share this video, and subscribe to the channel. Thanks for watching. Are you worried you're going to get caught out by the market crash that will inevitably come because the market moves in patterns? Well, that's what Hugh just told me to watch out for. And in all seriousness, there is actually a structure to predict the market patterns. It happens with 90% accuracy. And I want to walk you through that. So you are better prepared, because guess what? Nobody expects a crash when the markets are doing fantastically well as they have been.